I'm Paula Jazabkowski, and I'm going to talk to you about the book that I wrote with my colleagues Rebecca Bednarek and Paul Spee on the market for trading in disasters, what we call making a market for acts of God, which is the global reinsurance market. Now, we observed this market at a time when it had worked historically, despite the uncertainty of disasters, but was going through a rapid change from what we termed a market for acts of God to a market for commodities. We studied it over 3 years, so we had a significant period of time, and we studied it globally and ethnographically, which involved a team of us working on these observations all around the world with the different underwriters who were writing these disaster risks. Now, the thing about disaster risks, floods, tsunamis, earthquakes, hurricanes, is that they're unpredictable, they're very severe, and they can be of extremely high value depending on, if they wipe out, for example, a large chunk of, for example, the Florida coastline. They originate anywhere in the world, and we watched risks everything from flood in India and terrorism in Pakistan to sort of hurricanes in the Caribbean. And the point about these is that they are syndicated between distributed actors. What that means is that everyone ends up taking a share of the risk and same prices for the same layers, how close you are to that risk. And yet that couldn't be explained by existing theories, because existing theories were about embodied presence, so open outcry markets and people who see each other trading, or they were about electronic markets where people are watching a ticker tape or a computer. Whereas what this is are individualized deals, but the people don't see each other, they don't know what each other are quoting, and yet somehow they end up collectively bearing this risk. And based on that, we develop a new theory of relationality in markets. And this, of course, is why we decided to follow risk trading practices globally rather than studying organizations or a single geographic region, which is that you put the relations and practices of a market ahead of the individuals or the organizations. You try to work out what these relations and practices are. And we took an approach where we term nested relationalities, where any particular actor at any moment in time trading any particular deal, what they're doing is absolutely critical for that deal. At the same time, it's distributed, and there will be maybe 60 of them critically doing something critical for that deal. And so all of them will also be partial. So there's nested relationalities. And what we show is that they have a relational presence with each other, even when they don't know each other, through the common practices that are distributed across this marketplace. Now, we do use this conceptual scaffold from Shatsky in order to understand these relational practices. And it's very useful because it allows us to focus on things like, where things happen, like quoting on deals or how firms enact their risk appetite, but situate those in these relational practices through which people are relationally present with each other, such as the general understandings, coordinating practices, and practical understandings. Now, I'm just going to give you a brief feel for how this market works and how we were able to unpack those things. It's always been a very cyclical market. You see this kind of a graph. Well, in many markets, if you saw that, you'd think this is boom and bust. Why is it so cyclical? But cycles are considered essential in trading in this market because you don't know when a disaster is going to happen. So the longer you are away from a disaster happening, the cheaper and cheaper the price is for trading the risk. And then a big disaster happens, and that might actually exceed the price of all the premiums that you've been collecting over decades, but afterwards you charge more. So after the loss, you then charge more for your capital, and that's how you make it back. And so this is a kind of collective approach, but it's tacit. There is no requirement for people to pay more after they've had a loss, or for companies to pay more after they've had a loss. This is just a tacit way that the market has learnt to work in order to ensure stability against unpredictable disasters that could otherwise, like the current pandemic, wipe out the entire book of a reinsurance company. So what this is doing is, this is a market where you can't really establish the price of something unpredictable in advance. Of course, there's pricing models, but the price is very much a social fact. And really, price is grounded in a concept of relationship, and that you will get payback post-loss. So if you have a relationship with those with whom you trade, they trade their disaster to you. If you lose in a year that you have to pay out, you'll get that money back through the relationship in the longer term. And this stabilizes the flow of capital between buyers and suppliers through what looks like really quite major cyclical swings. Now, this is a little bit predicated, though, on a problem that each insurance product or each reinsurance product is renewed annually. So, of course, you've got an annual renewal of something that needs to create a long-term relationship. The other thing that is going on is a sort of price discovery mechanism. As you know, everyone has to take the same price, but they don't know what each other are quoting. So people put in a price that they quote for the amount that they would like, how close to the risk, and then one price is decided and paid out across all the market. Now, this actually helps to counteract the problems or the inaccuracies of models in a market like this, where, for example, you may have only been drilling for 40 years, and yet you're trying to talk about what's a 1 in 500 scenario of a disaster happening in that area. And so when we get at these kind of quoted prices and everyone has to take the same price, it kind of smooths some of the competitive behaviours, because on the one hand, people are competing to get shares of the deals they want. On the other hand, they're respecting the wisdom of price that is created by the crowd, which shouldn't suppress the price too much. Now, we map this out as a set of nested relationalities because there are thousands of deals going on all around the world, and all of them have this price making going on, and all of them are considering, is there a cycle to be paid back on a loss on any of these? And so, any specific deal is mapped out, as a bunch of relationalities across the world between actors who don't know each other, but can assume that each other are working to the cycle and that each other are working to the wisdom of the crowd in their pricing of any particular deal. So what do we get from this kind of relational presence that they have and these nested relationalities in placing deals around the world? We get a collective bearing of risk in which everybody has the same skin in the game at the end of the day. And we get a broad base of expertise, a bunch of people who may not know each other, but all have a great deal of expertise in the specific risks that they're dealing, and where therefore you may have trust in the expertise and practices of some other whom you do not know. So this market works and has worked really for a couple of 100 years or more around very uncertain disasters, because it has these nested relationalities based on cycles and the collective pricing of bearing of risk, and people are relationally present to each other in trading risks, even when they can't see each other, and even when there's no electronic, tape or board from which to calculate what others are doing. And this makes it work despite the unpredictability, uncertainty, and severity of the losses. However, we also observed this market going through some rapid changes, which were the outcome. We started watching in 2009. The outcome of the global financial crisis was that the big insurers were exposed to greater regulatory scrutiny, even though they had not failed, and they were required to hold more capital and be more solvent against the risks that they were holding. And that changed the way that they were therefore buying their reinsurance products. They were bundling the risks, so instead of buying localized products for specifically Florida or specifically California or specifically Japan, they started to bundle that risk around the world, and that made it more efficient for them to purchase. It made their capital more efficient, and it drove down the costs of what they were actually purchasing. The problem with that is, on the one hand, that looks like strategy 101. Of course, you should be more efficient. Of course, you should drive down cost. Of course, you should, maximize your global value chain. But when you're doing that to trade risks, what you actually do is therefore start to get away from the local nature of the risk. It's, people know what is the specific buildings and sites in this area. What's their possible predisposition to a collapse because of a wind or an earthquake or so forth, or windstorm. So you lose that sort of wisdom that is being used in local situations, and that is part of the relational presence with each other. I know this risk, I make this price, others can trust this price because they can trust my knowledge, even if they don't know me. But then that gets eroded because these big products take 6 months to analyze, and we move from sort of knowing something about the risk itself to simply seeing them as very abstract. For example, my risk portfolio is 4.2. a risk portfolio of 4.2 is very different to buildings that have sprinklers in them in the event of fire. So this is what starts to happen, a change in the way we trade risk. And as we do that, while it's not immediately apparent, we're changing the nested relationalities on which a market for unpredictable risks for acts of God works, from unpredictable to specified and precise, from a broad base of expertise to a narrow focus on models and measures, from collective risk bearing, where we all have skin in the game, to transactional risk bearing, which is not market cycle and I'll pay you back if we got it wrong, but who's the lowest cost provider in any year. And so we really alter the basis of the relational presence, perhaps in ways that aren't initially known. And we predicted that the cycle had indeed disappeared. And that is the case today. Despite all the disasters we've seen over the past 3 to 4 years, including a pandemic, we still don't see a truly hard cycle in this market anymore. And we say that this is actually problematic when we think about moving from a market for acts of God, and yet the purpose of this market is to transfer risk in ways that make sure we get payment when we have a disaster. And if we assume this is just a commodity, measurable, tradable, and sanitized, when it's actually something that's severe, uncertain, and actually increasing through climate change and things, then if we change from an acts of God approach to a commodities approach, we may well predispose this market to some of the collapses. Then, the problems that we see right now with the insurance market's struggles to pay for the disasters it's faced this year, not only pandemic, but bushfires and floods around the world and droughts. So why a book? Why is a book a good way to study something like this? Because it allows us to develop new theory on the workings of a global market. Of course, we've written papers, but the papers are snapshots on one small thing in a marketplace. And they can tell you something about, Lloyd's of London, or about specifically trading very measurable and modelable risk like hurricane in Florida. But to show that whole relational nature through which one market, one basic set of capital and one key set of providers can trade anything from something as uncertain as flood in India to something, while still uncertain, but much more measurable as hurricane in Florida, and how it can balance that against bushfire in Australia and so forth, needs the depth and breadth of a book in order to explain something that otherwise we wouldn't understand. And we need to understand how these markets work because our pensions are invested in them. We mortgage our houses based on feeling secure that they will work and that they will pay for us after a disaster. And so I think that books offer the opportunity to both develop new theory, and there's nothing so practical as a good theory, to understand a market and the practical workings of a market in ways that will make us more sensitive to what might make that market collapse or what make it more robust, given that it literally is our houses that are invested through this market. So I hope that that's been helpful for you in thinking about both our book, but also why books. Books are critical if we're going to be able to understand really complex phenomena like markets or like some of the other big social issues we're facing today.